accounting equation. We're going to use all what I just talked about, all this theory, which is rather complicated and you can go down the weeds in it, but I'm going to go straight into application. And so how do we apply this theory? And you're going to learn more about this theory through how we apply it. And so the fundamental thought of a business is we have the accounting equation. The accounting equation is how we apply all this crazy framework goes down to the accounting equations and debits equal credits. There's 2 rules in accounting that you need to memorize. The accounting equation, which is assets equal liabilities plus equity, and debits always equal credits. If you memorize that, you're on like a really good path for accounting. Sounds simple, but the operations, the devil's in the details. So what do I mean? Assets equal liabilities plus equity. Another way to say this is assets equal liabilities plus common stock minus dividends plus revenues minus expenses. Now, this seems like a lot. There's a lot here, but something that you should all like if you don't want to be math majors is I think we all learned addition and subtraction. I think we all know that. We're good, right? Addition and subtraction, that's all accounting is. And some allocation, some multiplication. We're not doing any crazy theories here. We're not doing derivatives. So we can worry about the math complexity. We can leave it out. It's how we apply the math that can get complicated. So what are assets, liabilities, and equity? I need you to memorize this. And I also want you to just memorize, and I'll talk about the theory behind it, memorize the expanded accounting equation as well. That assets equal liabilities plus contributed capital plus retained earnings. Equity is contributed capital plus retained earnings. And retained earnings is dividends, revenue minus expenses minus dividends. And I have YouTube videos on this that goes into a lot of detail, but I'll cover it higher here, but make sure you watch those videos as well. So first off, we'll just do some basic math. I'm going to go into what an asset is, what a liability is, and what equity is, but I just want you to be able to make sure you can manipulate the equation. So if I tell you, hey, we have $150 in assets and $30 in liabilities, how much equity does Bose have? 120, right? We can just do the math. We can do the math right here. Where's my calculator? I want to make sure we're all there, and I can do it on Google Sheets too if it helps. 150 minus the 30, we get our 120 in equity. Simple math, right? If I say, what's our assets when we have liabilities of 100 and equity of 300? 100 plus 300, our assets would be 400. Simple. We make it more advanced. What if our assets are 200, liabilities are 80, equity is 120, and we have common stock of 100 and expenses of 40? How do we get our revenues? And so we'd have to divvy up the 100, right? We know the 100 minus 40 is 60. That's our revenues. So it's just simple variable equations. Make sure you practice this. And if you're having trouble on this math, make sure you reach out to me and let me know, because you need to make sure you can do single variable equations before you take this course. So practice it and make sure you understand this equation and how to manipulate it. So how do we use the accounting equation to analyze business transactions? So we're going to go just that concept of a company, and I'm going to talk about a little bit about what assets and equity are. So assets are everything the company has, right? So you think of yourself as a company, I might have $100,000 in the bank, a home, and a car. Those are my assets. That's everything the company has. But how are those assets funded? You can either fund them through your work, like I've worked most of my life, so I saved up and bought the car, right? That's one way to fund your money, fund your assets. The second way is I could borrow. I could just go to the car dealership and say, hey, give me one of these horrible loans so I can get a new Tesla. That's the second way, right? So we can have the Tesla through debt, or we can have it through hard work, through equity. We can also go to our friends and say, hey, do you want to own this Tesla with me? Hey, you can go to your wife or your husband or your girlfriend, boyfriend, and say, hey, you want to buy it with me? Get it 50% of the time. That's equity. Now you're a partnership, right? And they've given you some extra money in order for you to buy the car together. That's equity. And so that's the whole accounting equation. We're just saying what a business has is equal to what they borrow plus what they've either funded through themselves, through their hard work, or through partners funding money. So let's walk through a business. So let's say Chaz Taylor wants to invest $30,000 to start a company. First, remember the economic entity principle. Chaz is different than his business, right? Chaz is different than his business. So Chaz wants to invest $30,000 into his company. He's taking money out of his pocket, putting it in the company. We only assess the company's financial statement impact. So we increase an asset account by $30,000, and we increase an equity account by $30,000. That means here, assets will equal 330,000, equity will equal 30,000. The equation equals, we're okay. That's what we see here. Assets went up 30,000. Assets, what does a business have? They have cash. How did they get that cash? An owner gave them money. That's equity. Why is that important? Because that owner can take money away in the future, right? The owner has a right to a dividend in the future if they want it. The accounting equation is in balance, so we're okay. All transactions are going to either increase or decrease assets, liabilities, or equity. All transactions. So let's say, hey, the company now purchased supplies by paying $2,500 in cash. So we are purchasing supplies. What are supplies? Are supplies an asset or are they an expense? That's going to be really challenging. Well, based on the revenue recognition principle, we know that supplies can only be expensed in the period where revenue is recognized. That means since we haven't used those supplies yet, we're not going to expense them. We're going to do something called capitalize the supplies. We're going to capitalize them. What does that mean? We're going to make them, they're considered assets. They're going to be a future expense, but we consider them assets. So we're spending cash. We decrease the cash in exchange for supplies. So we're decreasing an asset in exchange for an asset. Our assets don't change. These are the kind of questions I can ask you on a quiz or an exam. Hey, if I sold supplies or I bought supplies for cash, what's the impact on the financial statements? Or what's the impact on the accounting equation? And you tell me nothing, there's no impact. You got an asset, you just changed hands of the asset. What if I purchased equipment for $26,000 cash? Purchased equipment for $26,000 cash. We decrease an asset, we decrease our cash in exchange for another asset. Where students get tripped up is students might think this is an expense. Hey, we spent the cash, so it's an expense. No, it's an asset. We can use that to generate future revenue, right? We're going to use that to generate future revenue. So we're not going to expense it until the periods where we generate the revenue. So we decrease our cash again, and we increase our equipment. Decrease cash, increase equipment, all assets, still no impact on the financial statements. We have no new liabilities, equity is the same, and only assets have changed hands. Now the business no longer has any cash, or it has $1,500 cash, $2,500 in supplies, and $26,000 in equipment. This is an awesome way to think about business. This is such a good way to think about business because now you're thinking about what you have and how you're allocating what you have to make money. Right? This is the way, if you're going to drive an Uber or if you're going to start your own business, this is the way you have to think. Am I using my money in a wise way to generate revenue? A different way of thinking. So let's say next transaction. And this is a way, just so you know, you're going to learn accounting, is just drill the transactions. Go through transactions, make sure you understand why it is what it is. If you think it to be an expense and it's wrong, then go back and try to think through it. Or reach out to me, or reach out to your fellow students. But you have to drill thousands of transactions. Purchase supplies of $7,100 on credit. What are supplies? Supplies are an asset, right? We use them. What's credit? That's a liability. That means we owe somebody money. That's how the financial statements are going to change. We didn't have enough cash. We bought more supplies. And then we increased an account called accounts payable. That means we bought something on credit, on short-term credit. Accounts payable is a short-term credit. That means now we have $37,100 in assets. $37,100 in assets. That's equal to $30,000 of equity. 30,000 of this is mine, and 7,100 is somebody else's. If I liquidated my business today, I would owe $7,100. Does this make sense? Is everyone following along? This is how we need to think about business. What do I own in it? what do other people own? Who's internal, who's external? We are always separate than our business. Okay. There's a lot there. Any questions?
Yeah, sorry. So about counting supplies and equipment as both assets. So the idea here, just to check, is like you're counting their monetary value, right?
Yeah, we're not just the monetary value, their historical cost.
Oh, okay.
Always at
Thank
cost. Yeah, great question. So even if I bought equipment and then it went up in value, that doesn't matter. The equipment's always going to be at cost. What is cost? Cost is what the day I paid for it, day one, when I receive the asset. Any other questions? What's great about accounting, what's awesome about it, is if you use the accounting equation, you know when you're wrong. If it's out of balance, you're wrong. You need to go check your work. That's awesome. That means it's one of the few times where you know that, hey, my answer needs to balance. I have a check built into my answer, right? If you go to chemistry, you're not going to have that. You can get the wrong answer, right? Engineering, you can get the wrong answer. Here, we need to balance. We know when we did something wrong. Okay. So we're going to get a little more complicated now. So what happens when we have revenue, expenses, and dividends? Before we get there, I want to make sure, I'm kind of jumping ahead of the book here, but I want you to, I think this is the best way to know of it. This is on our financial statements. This is our balance sheet, by the way. Our balance sheet, what we're going to talk about in more detail, it's our assets, liabilities, and equity. This is our balance sheet. When we talk about revenue and expenses, we're going to talk about our income statement. So we talked about what if we provide consulting services to a customer and receive $4,200 in cash right away? Cash is an asset. Cash is going to increase. Assets are going to increase. Revenue will increase. We earned some money. We earned it, right? Revenue recognition principle, we earned it. We can recognize it, and we received cash. How does that affect the accounting equation? Our assets go up, and our equity goes up because we have a right to that. We have the right to that money. But no one else has a right. We earned it. But then we had to pay rent. So we paid rent of $1,000 and salaries of $700. So our assets go down for the cash we paid, and then we have expenses for what we used. Expenses match the revenues, right? We didn't prepay the rent. The salary, the services already happened. Our employees already worked. So we have to expense and recognize that expense. So our expenses will be $1,700 and our cash will decrease. These things, 6 and 7, this is called a footnote. Also what we call in accounting tick marks. We call them tick marks. And the way that we use this is say, this is transaction 6, this is transaction 7, so we follow the details. Transaction 8, what if we provide consulting services for $1,600 and rent facilities for $300 to a customer for credit? So we received $1,600 cash. $1,600, and we also received another $300 for renting our facilities. So our accounts receivable is going to go up because it's on credit. You got paid credit. Accounts receivable means it's money people owe us. So our customer now has a liability. We have a receivable. Receivables are expected to be collected within the year. And then we're going to increase our revenues for both rental and consulting services. Why do we need to split them out? Because that's relevant information. I need to know if the business is making money predominantly through rental or through consulting. And so what we'll see here is accounts receivable goes up $1,900. We have a right to the cash, and our revenue goes up $1,900. Our accounting equation is still in balance. Always going to be in balance. And then let's say client in transaction 8 pays $1,900 for consulting services. So they paid off their accounts receivable balance for the consulting services. Our assets don't change. We just, is that right here? We just reduce the receivable and receive cash. Reduce the receivable and receive cash. Assets don't change. You're going to need to memorize all these transactions and make sure that you understand how it affects the accounting equation. What's challenging here? You need to know what an asset is, what a liability is, what are the equity accounts. Memorize those accounts. Asset accounts are what the company has, like cash, accounts receivable, supplies, equipment. Liabilities are what we owe, accounts payable, loans. Equity is what we have, what we've earned, or what our owners have given us internally, what we have. So that's our revenue, our expenses, our stock. Transaction 10. Fast Forward pays $900 as a partial payment for supplies. So we made a partial payment towards the supplies. So we reduce our cash and reduce our liabilities. We owed $7,100, we paid it off. Still in balance. The last transaction, how do the owners get money? The owners get money through salaries or dividends. So now that original guy who invested in the company, he wants a little money out of it. So he takes $200 out of it. That's called a dividend or a disbursement. So we're going to decrease the cash of the business and increase the dividends. The dividends reduce equity. So dividends reduce equity because it came out of the business, and we reduced our cash. Everything's still in balance. And then here's another example that we can go through on what it would look like for different transactions. I'll let you go through it. All the answer is here. Any questions?
What would happen if an owner tried to take out a dividend but the company has no cash?
Yeah, then they wouldn't be able to take out if there's no cash. And they could take out a dividend in equipment or supplies. Like you could take other things out of your company. But then if you have more liabilities than assets, then you start having issues, right? Like if you have no assets, you can't take out a dividend.
So, like, for example, if your company was a bakery, you would like literally take a stand mixer out of the kitchen, or how does that work?
Yeah, but normally you, as a owner, you probably wouldn't take a dividend if you had no assets.
Yeah, I was just curious.
Yeah, no, of course.
Thank you.
No, good question. Very good question. It happens. Yeah, you can take non-cash dividends. Any other questions? Good question. Yeah, let me explain dividends. So think about it this way. I own my company. I own my consulting firm. Let's say I made $10,000 last year in my consulting firm. My consulting firm made $10,000. Did I make $10,000? No, we're different entities. My consulting firm made $10,000. So I have a bank account. My consulting firm has $10,000 in it. I didn't have any of that money. I can get paid in two ways from my consulting firm. We're two separate things. We're two separate entities. I can either get a salary. My consulting firm might pay me $500 a month to work for the consulting firm, or I can take a dividend. I can say, hey, I want all that money out to use for my personal use. The money I take out for personal use is a dividend. So if we're giving money to owners, that isn't salary, it's a dividend. If we're paying a salary, that's a salary expense. So generally we give dividends to owners who aren't actively participating in their business. Or if you're a sole owner, like who doesn't take a salary. So let's say I own Apple stock and Apple wants to give money to its owners. Apple has thousands and thousands of owners. So in order to pay dividends, those owners don't do it. I own Apple stock. I don't do anything for Apple, right? I don't help out Apple. So they'll pay a large dividend, and that dividend gets distributed by share to each of the owners. That's a way for Apple to pay some of its owners. That's why companies go public, is so multiple people will give them money in order to own part of the company. That way the company gets a bunch of money, gets a bunch of notoriety, and then investors can get a passive investment through dividends. If I'm an employee, I get a salary. Does that make sense? Any more question on dividends?
Question.
Yeah.
How did dividends differ from withdrawals?
How does it differ from what?
Withdrawals?
Dividends and withdrawals are synonymous. They're the same. So,
okay.
Yeah. So just different words for the same transaction. So if I'm a partner or a sole owner, sometimes we just call them withdrawals. But if I own stock, it's generally called a dividend. All mean the same thing. An owner is taking money out of the company. And why is that important? When a company pays a dividend, they no longer have the cash, and it's going to reduce the equity. It's going to reduce the owner's right to cash in the future. That way we can track, right? If we have partners, we can track, hey, maybe I'm a partner with a friend, and every time the business makes money, he pulls dividends out for himself. We can track and say, hey, you actually owe money to the company. You took out too much money. This is how we track and make records. Yeah, and that's a good question. Are dividends required? No, dividends aren't required. It's a trick question. I'm trying to keep it basic. 99% of the time, dividends aren't required. For tax purposes, there's some dividend requirements because there's some tax evasion you can do by holding money in your business. But that's too complicated. For this class, just think about it that the business gets to decide if they pay dividends. Who is the business? The business is business's management and their board of directors. They get to decide, well, we did a really good year. Let's pay our owners $1 per share or $2 per share. And you can look up any company and see the dividend ratio they paid out.